Question 1. An operations professional discovers that a customer has made several large, seemingly unrelated cash deposits into different accounts at the firm within a short period. This activity should prompt the professional to consider filing which of the following? A. A currency transaction report, CTR. B. A suspicious activity report, SAR. C. A large trader report, LTR. D. A material adverse change, MAC, notice. Answer: B. A suspicious activity report, SAR. When an operations professional observes activity that appears unusual or indicative of potential illegal financial activities, such as structuring deposits to avoid reporting thresholds, it is their responsibility to file a suspicious activity report, SAR. This report is crucial for alerting regulators to potential money laundering or other illicit financial behaviors, even if no single transaction meets a specific reporting threshold like the $10,000 for a CTR. Identifying and reporting suspicious patterns is a key component of a firm's anti-money laundering (AML) program. Always be vigilant for red flags that could indicate illegal activity. Question 2. Which of the following best describes a delivery versus payment (DVP) transaction? A. A transaction where securities are delivered before payment is received. B. A transaction where payment is made before securities are delivered. C. A transaction where payment and delivery of securities occur simultaneously, typically through a clearing agent. D. A transaction where the customer pays the broker-dealer directly, and the broker-dealer holds the securities for future delivery. Answer: C. A transaction where payment and delivery of securities occur simultaneously, typically through a clearing agent. Delivery versus payment, DVP, is a method of settlement where the buyer's payment for securities is made only when the securities are simultaneously delivered. This mechanism, often facilitated by a clearing agent, ensures that both parties fulfill their obligations at the same time, significantly reducing principal risk for both the buyer and the seller. For instance, an institutional investor might use DVP to ensure they only pay for the shares once they are confirmed as received. Understanding DVP is critical for managing settlement risk in securities transactions. Question 3. Under FINRA Rule 4511, most general business records of a broker-dealer, such as blotters and general ledgers, must be preserved for a minimum of how many years? A. 3 years. B. 4 years. C. 5 years. D. 6 years. Answer: D. 6 years. FINRA Rule 4511 outlines the record retention requirements for broker-dealers, stipulating that most general business records, including blotters, general ledgers, and customer account records, must be maintained for a minimum of 6 years. These records are vital for regulatory oversight, auditing, and ensuring compliance with securities laws. It's important to remember that certain records, like customer complaints, have specific longer retention periods, but 6 years is a common baseline for many core operational documents. Always know your firm's specific record retention policy for various document types. Question 4. All of the following information is generally required under the Bank Secrecy Act, BSA, to verify a customer's identity when opening a new account, except A. Customer's name. B. Customer's date of birth. C. Customer's email address. D. Customer's physical address. Answer: C. Customer's email address. The Customer Identification Program, CIP, requirements under the Bank Secrecy Act, BSA, mandate that financial institutions collect specific information to verify a customer's identity, including their name, date of birth, physical address, and taxpayer identification number. While an email address might be collected for communication purposes, it is not a required element for identity verification under CIP regulations. This information helps combat money laundering and terrorist financing by ensuring customers are who they say they are. Remember the core 4 pieces of information required by CIP. Question 5. Which of the following corporate actions would result in an increase in the number of shares outstanding and a decrease in the par value per share, while maintaining the total value of an investor's holding? A. Stock split. B. Reverse stock split. C. Stock dividend. D. Cash dividend. Answer: A. Stock split. A stock split is a corporate action where a company increases the number of its outstanding shares by dividing existing shares into multiple new shares. For example, in a 2-for-1 split, an investor holding 100 shares at $50 per share would then hold 200 shares at $25 per share, increasing the share count and decreasing the per share price and par value, but the total value of their investment remains the same. This action often makes shares more accessible to a wider range of investors. Keep in mind that a reverse split does the opposite, reducing the number of shares and increasing the price per share. Question 6. A broker-dealer must segregate customer securities and excess margin securities in a way that ensures they are: A. Available for the broker-dealer's proprietary trading activities. B. Used as collateral for the broker-dealer's bank loans. C. Protected from the claims of the broker-dealer's creditors in the event of firm insolvency. D. Held in street name and easily transferable to other customer accounts. Answer: C. Protected from the claims of the broker-dealer's creditors in the event of firm insolvency. Broker-dealers are required to segregate customer securities and excess margin securities from the firm's own assets. This crucial regulatory requirement ensures that if the broker-dealer becomes insolvent or declares bankruptcy, customer assets are protected and are not subject to the claims of the firm's general creditors. This segregation is a fundamental aspect of customer protection rules, similar to how a bank keeps customer deposits separate from its own operating funds. Always remember that customer funds and securities must be clearly separated from the firm's assets to safeguard clients. Question 7. An unexpected outage of a broker-dealer's trading platform due to a hardware malfunction represents which type of risk? A. Market risk. B. Credit risk. C. Operational risk. D. Liquidity risk. Answer: C. Operational risk. Operational risk refers to the risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. An unexpected outage of a trading platform due to a hardware malfunction falls squarely into this category because it relates to a failure in internal systems and processes. This type of risk can disrupt business, cause financial losses, and damage reputation. Understanding the different types of risks, like distinguishing operational issues from market fluctuations, market risk, is essential for effective risk management. Question 8. In a brokerage account, a DK notice is typically sent to resolve a discrepancy between two parties involved in a trade. DK stands for: A. Don't know. B. Due kind. C. Delivery key. D. Data known. Answer: A. Don't know. A DK notice, which stands for Don't Know, is an important communication tool used in the securities industry to resolve trade discrepancies between two broker-dealers or a broker-dealer and another party. When one party receives a trade confirmation that does not match their own records, or they simply have no record of the trade, they will send a DK notice to the other party to initiate an investigation and resolve the mismatch. This process helps ensure accurate and timely settlement of transactions. Think of DK as a way of saying, "I don't recognize this trade, let's figure it out." Question 9. What is the primary purpose of Regulation T, as established by the Federal Reserve Board? A. To regulate the issuance of new securities. B. To govern the extension of credit by broker-dealers for the purchase of securities. C. To set standards for anti-money laundering compliance. D. To dictate disclosure requirements for public companies. Answer: B. To govern the extension of credit by broker-dealers for the purchase of securities. Regulation T, promulgated by the Federal Reserve Board, dictates the amount of credit that broker-dealers can extend to customers for the purchase of securities in margin accounts. It sets the initial margin requirement, which is currently 50% for most equity securities. This regulation aims to control the amount of speculative credit in the securities markets, thus helping to prevent excessive leveraging and potential financial instability. Remembering T for trade credit or T for 25%, referencing the Fed's historical power to set this, can help you recall its purpose. Question 10. The main purpose of securities lending is to A. Allow broker-dealers to borrow money from banks using securities as collateral. B. Facilitate short selling and cover failed deliveries. C. Provide a way for customers to earn interest on their long positions. D. Enable companies to raise capital by issuing new debt instruments. Answer: B. Facilitate short selling and cover failed deliveries. Securities lending primarily involves the temporary loan of securities from one party, the lender, to another, the borrower, typically a broker-dealer or institutional investor. The main purposes are to facilitate short selling, where the borrower sells borrowed shares hoping to buy them back at a lower price, and to cover failed deliveries, ensuring that trades settle on time even if the original seller couldn't deliver. The borrower provides collateral, usually cash or other securities, to the lender. Think of it as providing the necessary shares for market liquidity and specific trading strategies like short sales. Question 11. Which FINRA system requires broker-dealers to report execution information for transactions in NMS stocks and OTC equity securities? A. OATS, Order Audit Trail System. B. TRF, Trade Reporting Facility. C. EMA, Electronic Municipal Market Access. D. RTRS, Real-Time Transaction Reporting System. Answer: B. TRF, Trade Reporting Facility. The FINRA/NASDAQ Trade Reporting Facility, TRF, is the system used by broker-dealers to report over-the-counter, OTC, transactions in exchange-listed securities, NMS stocks, and certain OTC equity securities. This facility facilitates the capture and dissemination of trade data, contributing to the transparency of the equity markets. While OATS records order lifecycle events, the TRF is specifically for reporting executions of trades in these securities. Remembering that TRF is for trade reporting helps to distinguish its function from other FINRA systems. Question 12. If a registered operations professional resigns from their position, their employing broker-dealer must file a Form U-5 with FINRA within how many days of termination? A. 10 calendar days. B. 30 calendar days. C. 60 calendar days. D. 90 calendar days. Answer: B. 30 calendar days. When a registered representative, including an operations professional, terminates their association with a member firm, the firm is required to file a Form U-5, Uniform Termination Notice for Securities Industry Registration, with FINRA within 30 calendar days of the termination date. This form notifies regulators of the individual's departure and indicates the reason for termination. Accurate and timely filing of Form U-5 is crucial for maintaining proper regulatory records and ensuring compliance. This requirement helps FINRA track individuals' registration status within the industry. Question 13. A registered operations professional supervisor must approve which of the following actions, according to FINRA rules? A. All customer trade confirmations before they are sent. B. All customer new account applications. C. All daily reconciliations of firm positions. D. All internal memos regarding operational procedures. Answer: B. All customer new account applications. FINRA rules mandate that a principal, supervisor, must approve all new customer account applications. This approval process is critical for ensuring that the account is suitable for the customer, all required information has been collected, and the firm's internal policies and regulatory requirements for account opening have been met. While other operational tasks are important, the supervisory approval of new accounts is a specific regulatory requirement designed to protect both the firm and the customer. Remember that opening a new account is a major step that requires principal oversight. Question 14. When handling a written customer complaint, an operations professional's first step should typically be to A. Attempt to resolve the complaint directly with the customer. B. Forward the complaint immediately to FINRA. C. Report the complaint to a supervisor or designated principal. D. Delete any electronic records related to the complaint to protect privacy. Answer: C. Report the complaint to a supervisor or designated principal. Upon receiving a written customer complaint, an operations professional's immediate and critical first step is to report it to a supervisor or designated principal. Firms have established procedures for handling complaints, which often involve a principal reviewing and investigating the matter. Attempting to resolve it independently or forwarding it directly to a regulator without internal review would bypass proper protocols and could lead to compliance issues. Remember that escalation to a principal is paramount for proper record keeping and resolution of customer complaints. Question 15. Regulation SP primarily addresses which of the following aspects for broker-dealers? A. Securities lending agreements. B. Margin requirements for options trading. C. Privacy of consumer financial information. D. Reporting of large trader activity. Answer: C. Privacy of consumer financial information. Regulation SP, issued by the SEC, establishes rules for how financial institutions, including broker-dealers, must handle non-public personal information of consumers. It requires firms to adopt policies and procedures to protect this information and to provide customers with privacy notices that explain how their data is collected, used, and shared, as well as their right to opt out of certain information sharing. Think SP for security and privacy of customer data. This regulation is crucial for maintaining customer trust and ensuring data protection. Question 16. The primary purpose of a business continuity plan, BCP, for a broker-dealer is to A. Outline strategies for increasing market share. B. Ensure the rapid recovery of critical business functions after a significant disruption. C. Detail employee performance review processes. D. Plan for future expansion into new geographic markets. Answer: B. Ensure the rapid recovery of critical business functions after a significant disruption. A business continuity plan, BCP, is a comprehensive strategy designed to ensure that a broker-dealer can continue to operate and recover its critical business functions quickly and effectively in the event of a significant disruption, such as a natural disaster, cyber attack, or extended power outage. The BCP outlines procedures for maintaining essential operations, restoring systems, and communicating with customers and regulators. This planning is vital for minimizing losses and maintaining investor confidence during unforeseen circumstances. Firms must test their BCP regularly to ensure its effectiveness. Question 17. Which of the following is considered free credit balance in a customer's brokerage account? A. The total value of securities held in the account. B. The cash remaining in a customer's account that is not invested or used for margin. C. The amount of outstanding margin loan. D. The value of unexercised options contracts. Answer: B. The cash remaining in a customer's account that is not invested or used for margin. A free credit balance refers to the uninvested cash held in a customer's brokerage account that is readily available for withdrawal or for purchasing securities. This cash is not part of a margin loan and is not earmarked for any specific investment or payment. Broker-dealers must inform customers of their free credit balances on their account statements and ensure these funds are held in a segregated account to protect them. This balance represents the liquid portion of a customer's holdings, ready for their use. Question 18. A transfer agent's primary responsibility is to A. Execute buy and sell orders for securities. B. Maintain records of stock and bond owners, including changes of ownership. C. Underwrite new issues of securities for corporations. D. Provide investment advice to clients. Answer: B. Maintain records of stock and bond owners, including changes of ownership. A transfer agent is a third-party entity, often a bank or trust company, hired by a corporation to manage the records of its stock and bond owners. Their primary responsibilities include issuing and canceling certificates, keeping records of ownership changes, distributing dividends and other payments to shareholders, and handling lost or stolen certificates. They act as a crucial link between the company and its investors, ensuring accurate ownership records. Think of them as the official record keeper for a company's shares. Question 19. Under FINRA Rule 5130, which of the following is generally considered a restricted person, and is prohibited from purchasing shares in a new equity IPO? A. A registered representative of the managing underwriter. B. A customer of the broker-dealer with over $100,000 in assets. C. An institutional investor with over $50 million under management. D. An employee of a publicly traded company. Answer: A. A registered representative of the managing underwriter. FINRA Rule 5130, also known as the Restricted Persons Rule, prohibits various individuals and entities associated with the securities industry from purchasing shares in a new equity IPO, initial public offering. This rule is designed to ensure that new issues are offered to the public and not disproportionately allocated to industry insiders. A registered representative of the managing underwriter, along with other broker-dealers, their employees, and certain family members, are explicitly defined as restricted persons. This prevents preferential treatment and promotes fairness in the IPO allocation process. Question 20. When an options contract holder decides to exercise their option, what is the role of the Options Clearing Corporation, OCC? A. To provide investment advice to the option holder. B. To guarantee the performance of options contracts and facilitate the exercise and assignment process. C. To market new options products to investors. D. To set the strike prices and expiration dates for options contracts. Answer: B. To guarantee the performance of options contracts and facilitate the exercise and assignment process. The Options Clearing Corporation, OCC, is the primary clearing agency for options contracts in the United States. Its crucial role is to guarantee the performance of options contracts, meaning it stands between every buyer and seller, ensuring that obligations are met upon exercise or assignment. When an option is exercised, the OCC facilitates the delivery of the underlying securities and the payment of funds between the exercising party and the assigned party. Think of the OCC as the central counterparty that eliminates counterparty risk for options traders. Question 21. The net asset value, NAV, of a mutual fund is calculated. A. Once per day at the end of the trading day. B. Continuously throughout the trading day. C. Weekly, based on the average price of the underlying securities. D. Monthly, based on the fund's income and expenses. Answer: A. Once per day at the end of the trading day. The net asset value, NAV, of a mutual fund represents the per-share value of the fund's assets minus its liabilities. By regulation, mutual funds are required to calculate their NAV once per day, typically at the close of the major U.S. stock exchanges, 4 p.m. Eastern Time. Orders to buy or sell mutual fund shares are then executed at this calculated NAV, meaning investors don't know the exact price until the end of the trading day. This forward pricing mechanism is a key characteristic of mutual funds. Question 22. When a municipal bond trades in the secondary market between interest payment dates, the buyer typically pays the seller. A. The accrued interest from the last interest payment date up to, but not including, the settlement date. B. The full next interest payment, regardless of the trade date. C. The interest from the trade date up to the next interest payment date. D. No accrued interest, as interest is paid directly by the issuer. Answer: A. the accrued interest from the last interest payment date up to, but not including, the settlement date. When a bond, including a municipal bond, is traded in the secondary market between its interest payment dates, the buyer must pay the seller any accrued interest. This, accrued interest, represents the portion of the next interest payment that the seller has earned since the last payment date but will not receive directly from the issuer because they are selling the bond. The calculation runs from the last interest payment date up to, but not including, the settlement date of the trade. This ensures the seller receives their earned interest, and the buyer will then receive the full next coupon payment from the issuer. Question 23. A market order, placed by a customer instructs the broker-dealer to A. Buy or sell a security at a specified price or better. B. Buy or sell a security immediately at the best available price. C. Buy or sell a security only if it reaches a specific price target. D. Buy or sell a security at the closing price of the day. Answer, B. Buy or sell a security immediately at the best available price. A market order is the most basic type of order and instructs a broker-dealer to execute a trade immediately at the best available price in the market. There is no price guarantee with a market order, the priority is on speed of execution. For instance, if you place a market order to buy 100 shares of XYZ stock, your broker will fill that order as quickly as possible at whatever price is currently offered. Operations professionals must understand that market orders prioritize execution over price. Question 24. Under FINRA rules, a gift or gratuity given by a broker-dealer to an individual associated with another firm is generally limited to a value of no more than A. $50 per year. B. $100 per year. C. $250 per year. D. $500 per year. Answer, B. $100 per year. FINRA rules prohibit broker-dealers and their associated persons from giving anything of value in excess of $100 per year to any person associated with another member firm, if such payment or gratuity is in relation to the business of the recipient's employer. This rule, known as the Gifts and Gratuities Rule, aims to prevent situations that could appear to influence business decisions or create conflicts of interest. For example, a broker-dealer cannot send an expensive holiday gift exceeding $100 to a financial advisor at another firm if it relates to past or potential business. Remember this specific dollar limit for gifts within the industry. Question 25. To enhance cybersecurity, a broker-dealer should implement all of the following practices except A. Regular employee cybersecurity training. B. Strong password policies and multi-factor authentication. C. Storing all sensitive client data on unencrypted local drives. D. Implementing intrusion detection and prevention systems. Answer, C. Storing all sensitive client data on unencrypted local drives. Storing sensitive client data on unencrypted local drives is a highly insecure practice that significantly increases the risk of data breaches and compromises cybersecurity. In contrast, regular employee training, strong password policies with multi-factor authentication, and implementing intrusion detection systems are all essential cybersecurity best practices for broker-dealers. Protecting client data is paramount, and encryption is a fundamental safeguard against unauthorized access. Always prioritize data encryption and robust security measures to protect sensitive information.